Hi there, welcome to part 2 of our study under Profits and Gains from Business or Profession for deductions under section 30 to 37. So the first part we saw sections 30 and 31, and in this part we'll be seeing multiple sections, but then all these sections that we'll be seeing in this part will have a common factor, and that common factor is the term depreciation. So I'm pretty sure that most of you are aware of this term depreciation. We have come across this while learning accounts, right? WDV, straight line method, etc., etc. Just like that, Income Tax Act has a set of different kinds of depreciation. So the whole concept of depreciation is treated differently based on each category under Income Tax Act. And for each of those categories, we have separate sections. And let's check what all they are. First one, section 32(1)(1), straight line method depreciation for power sector assessees. So that is the first kind of depreciation, or the first category of depreciation as per Income Tax Act. Second one, 32(1)(2), WDV or normal depreciation, that is written down value. So these two depreciations form the basic depreciation. Alright, so depreciation can be split into, as per Income Tax Act, can be split into basic depreciation and additional depreciation. And then we have a special item called unabsorbed depreciation. Okay, so three splits for depreciation. So this is your basic depreciation. SLM for power sector assessees only, and WDV or normal depreciation, which is applicable for all kinds of assessees. Even power sector assessees can take WDV. It's to their option actually, whether they want to take WDV or SLM. Alright, now after WDV we have the additional depreciation that I talked about, the second category. So these two are the first category of basic depreciation. 32(1)(2)(a refers to additional, enhanced or accelerated depreciation. This is a depreciation provided over and above the basic depreciation for assessees who take WDV. So if an assessee goes with WDV as their basic depreciation, then that assessee, if he or she or the corporate fulfills certain criteria and conditions, then they can take an additional depreciation above this normal depreciation at 20%. Okay, that is your additional depreciation. Third category, unabsorbed depreciation. So these are the three categories of depreciations. 1 and 2, your basic. The third one, 32(1)(2)(a), your additional or enhanced or accelerated depreciation, applicable only for assessees who follow WDV and fulfill certain conditions. All those conditions we'll learn in detail in our detailed study for that particular section. And finally, the third category, unabsorbed depreciation. I will not be teaching you much on unabsorbed depreciation in this study of PGBP. Rather, you'll have a study for the same under the chapter carry forward and set off of loss. But then I'll be giving you a basic introduction or a basic understanding which is required for you to compute questions, compute income, income tax under the head PGBP. Right? And finally, there is one item left, which is actually not depreciation, but the treatment of it is very similar to that of depreciation. Hence, we can study it together, and hence Income Tax has clubbed it here itself, and that is 32(80), additional investment allowance or benefit, which is provided at 15%. Keep in mind, this is not depreciation. Alright, this is absolutely not depreciation. Rather, it is an allowance provided by the income tax to an assessee such that if the assessee makes an investment in a particular manner, if the investment is made in a particular manner, the assessee can take an investment allowance or benefit deduction at 15% over and above the basic, the additional and unabsorbed. Alright, see, unabsorbed is actually not applicable here. You'll understand that while we do few questions. But then just keep this in mind. This is an over and above deduction provided by the Income Tax Act to an assessee if the assessee makes an investment satisfying certain conditions. Now got a basic idea of all that we are going to learn here? Yeah? So before heading into these sections, let me give you a brief study, a very brief study on certain important points that you need to keep in mind while learning all these items. So let's check those important points first and then head to these sections individually. So yes, here are the important points that you need to know while learning the items under section 32 to 32 AD, which clubs depreciation and an item related to depreciation. So yes, let's check what those important points are. First and foremost, depreciation is a mandatory deduction. What it means by that is, this is a deduction the assessee has to take while computing taxable income regardless of him claiming it. So if it's not in your books of accounts, not a worry. You can take depreciation as per Income Tax Act for computing your taxable income. It is compulsory that you take depreciation. Two, very unique and very important point. See, this second point refers to assets that's not owned by you, rather taken on lease. So if the asset that you take on lease is a building, and if you incur any capital expenditure on that leased building, say you take a building and it's 2 floors, you incur a capital expenditure to build another floor and making it 3 floors. So 3-story building, you made the 3rd story. So it is a capital expenditure that you incurred on the leased building, right? And what Income Tax Act says is, if you have a building which is leased for the purpose of your business, that is important, the building should be leased for the purpose of business, and you incur a capital expenditure, it should be capital expenditure alone. Then for that capital expenditure, you can take depreciation. So depreciation available for capital expenditure for existing leased building used for PGBP. Important points are, the expenditure should be capital in nature and the asset should be a leased building, not available for revenue expense or any other asset. Leased building and capital expense. Clear? Cool. Third point. This is in regards to partnership firms. So normally a partnership firm can take depreciation benefit for all the assets it has in its name. But there might be scenarios wherein a partner contributes an immobile asset, say a plot of land to the partnership firm, but this land is not transferred to the firm's name. The partner keeps the asset in his name but gives the asset for the usage of the partnership firm. So it is an immobile asset. So when a partner gives an immobile asset to a partnership firm for the purpose of the partnership firm's business, then the firm can take depreciation regardless the asset being transferred to the firm's name. Okay, it's not necessary the asset to be registered under the firm's name. Okay, the only condition here is it should be an immobile asset brought in by the partners as capital contribution. Clear? Yeah. Point number 4, the most important one among all these important points. See, depreciation is attracted as and when an assessee buys an asset. But the benefit eligibility will only come, the depreciation deduction benefit eligibility will only come when the assessee puts the asset into use. What it means by that is, an assessee cannot take depreciation just by virtue of buying an asset. He will have to put that asset into use to get depreciation. Okay. So what Income Tax Act says is, you buy an asset and you put it into use in your financial year. Okay. And in that financial year, if you have used the asset for less than 180 days, then you will only get half of your normal depreciation. Say you buy an asset and the normal depreciation is 20%, a random figure. Okay, you use it only for 100 days. In this case, in the year you put to use, you cannot take 20% as depreciation. You can only take half of it, which is 10%. So putting to use is the category or criteria which makes an assessee eligible, not category, criteria which makes an assessee eligible for taking the deduction of depreciation. Fine? Clear? You will understand that once we head into detailed study of those individual sections. Don't worry. Next, depreciation available for both tangible and intangible assets. Next, buildings include roads attached. That's the key word, attached to it, and any well or tube wells attached. Right? Depreciation available for plants, and plants include ship, vehicle, books, scientific apparatus and surgical equipment. You have a detailed breakup of all these items in plants which will come in the study under section 32(1) to WDV. So don't worry, you will see what all are included in plants there. But does not include tea bushes, livestock, building and furniture. That is to say, any farming or animal husbandry related items will be out, and building and furniture will not be included in plants. They will be included separately. Alright. Next. During succession or amalgamation, that is to say when two organizations or two companies are amalgamating or one is taking over the another, how to compute depreciation? That's what this point says. Compute depreciation normally as if nothing happened. So A and B amalgamates to form AB. Okay. While computing depreciation, compute as if nothing happened. And after computing depreciation, based on the number of days, split or apportion this depreciation. It's the same as in there is A company, B company. Okay. A company has assets worth 10 lakhs, B company has assets worth 6 lakh. A company takes up B company and they remain to be A company alone. Okay. And this company has assets of 16 lakhs now. A company took over B company. So while computing depreciation, don't bother about this. All that you have to do is compute depreciation for A company and B company. So for 10 lakhs, I'm giving a random 20% for both. 20% for both. So the depreciation will be 6 lakhs 20% is 1.2 lakhs and 10 lakhs 20% is 2 lakhs, right? Now all that you have to do is take this 1.2 lakh, split it to B company and the amalgamated resulting AB company on the base of number of days. Say this B company and A company amalgamated and formed A company on the date of June 30th. Okay. And after June 30th, it is AB company. Alright. So on the basis of number of days, make a ratio. So from April 1st to June 30th and then July 1st to March 31st. On that ratio, split the depreciation. That's it. As simple as that. Okay. Nothing much. You will get a better understanding once we do few questions. And finally, unabsorbed depreciation can be carried forward indefinitely. Detailed study will be provided in the lesson of carry forward. Okay. Just keep in mind there is an item called unabsorbed depreciation, and by unabsorbed depreciation what it means is any amount of depreciation which could not be absorbed due to lack of profit. Say in a year you have a profit of 2 lakhs but depreciation of 2.5 lakhs. So you can take out you can take out this whole 2 lakhs with the 2.5. That will leave you at zero profit. Profit will be 0. Right? But a balance of depreciation remains at 0.5 lakhs. Right? Now this 0.5 lakhs is your unabsorbed depreciation. This you can carry it forward indefinitely. It can be set off even if this business does cease to exist. Alright? You'll have a detailed study in carry forward and set off chapter. Don't worry. So got all the important points? The ones that you need to be super careful are point number 4. This one very important. Point number 8, amalgamation, and point number 2. Also 3. So 2, 3, 4 and 8 are the most important points. Okay. So shall we head to the individual sections? Yeah. So let's check the individual sections now.